morning to everyone. Once again, I welcome you all in this online session. In the last session, you all have studied about sources of product for business, that is feasibility study of that. And today, I am going to teach you about ownership, capital and budgeting in the business preparation plan. That is 4.2 ownership, capital, budgeting, matching entrepreneur with the project, feasibility report preparation and evaluation criteria. In that first point, ownership. What is ownership? The ultimate and exclusive right confirmed by the lawful claim or title and subject to certain restrictions to enjoy, occupy, possess, rent, sell, use, give away or even destroy an item of property is nothing but ownership. Remember one thing, when you own a business, you are only taxed once. A sole proprietorship is not taxed as much as other business types. There are various types of ownership like sole proprietorship, partnership, private corporation, S corporation, and last one, limited liability company, that is LLC. Now, what is sole proprietorship? It is the simplest and most common form of business ownership. It is a business owned and run by someone for their own benefit. The business existence is entirely dependent on the owner's decision, is nothing but sole proprietorship. So when the owner dies, so he does the business. There are various advantages of sole proprietorship, like all profits are subject to the owner. There is very little regulation for proprietorships. Owners have total flexibility when running the business. And next one advantage is that very few requirements for starting, often only a business license. And also there are some disadvantage is there, like owner is 100% liable for business debits. Then equity is limited to the owner's personal resources. Ownership of proprietorship is difficult to transfer. No distinction between personal and business income. These are the few disadvantages of sole proprietorship. Or you can say a business owned and operated by a single individual, and the most common form of business structure is the sole proprietorship. The advantage with the sole proprietorship include ease and cost of information. Simply announcing you are in business and requesting any license and permits you may need. Use of profits, since all profits from the business belongs exclusively to you, the owner. Flexibility and control. You make all the decisions and direct the entire business operations. Very little government regulations, secrecy and use of ending the business. Now we will go for the second type of ownership, that is partnership. These come into two types, like general and limited. In general partnership, both owners invest their money, property, labor and so on to the business and are both 100% liable for business debits. In other words, even if you invest a little into a general partnership, you are still potentially responsible for all its debit. General partnership do not require a formal agreement. Partnerships can be verbal or even implied between two business owners. And limited partnerships require a formal agreement between the partners. They must also file a certificate of partnership with the state. Limited partnerships allows partners to limit their own liability for business debits and according to their proportion of ownership or investment. Again, there are some few advantages and disadvantages of partnership ownership. That is, first one advantage is that shared resource provides more capital for the business. Then each partner shares to the total profits of the company. Next one advantage is that similar flexibility and simple design of proprietorship and inexpensive to establish a business partnership formal or informal. Again, there are disadvantages like each partner is 100% responsible for the debits and losses. Selling the business is difficult, requires finding new partner, and partnership ends when any partner decides to end it. That is, in short, you can say a business that is owned and operated by two or more people, and the least used form of business organization in United States is the partnership. As I told you, there are two types, general and limited. General means what? All partners have unlimited liability, and while in the limited partnership, at least one partner has liability limited only to his or her investment, while at least one other partner has full liability. Now next one type of ownership is private corporation, a business that is legal entity created by the state whose assets and liabilities are separate from its owners, that is private corporation. While there are some public corporations whose stock, that is ownership, are traded on public stock exchange. Most small businesses are private corporations. A private corporation is owned by a small group of people who are typically involved in managing the business. Forming a corporation requires developing a legal document called the Articles of Incorporation and submitting them to the state in which the corporation wishes to reside. The advantages of corporation include limited liability. An owner can only lose up the amount he or she invested. Unlimited lifespan. A corporation is chartered to last forever unless its articles of incorporation state otherwise. Great sources of funding and ease of transfer of ownership. Again, there are disadvantages that include double taxation. The corporation as the legal entity must pay taxes, and then shareholders also pay taxes on any dividends received. This is all about private corporation. The next one is about S corporation, a form of ownership that is based of both partnerships and corporations is nothing but S corporation ownership. Owners have limited liability, greater creditability, that is obtaining financing, and no double taxation as all profits pass directly to the owners and the corporation pays no taxes. There are, however, restrictions on the number of type of shareholders. This is of S corporation. And last but not least, limited liability company is a form of ownership that is growing in popularity in the United States. Limited liability company provides limited liability and more and are taxed as partnership and sole proprietorship. This type of business formation formed by submitting articles of organization to the state in which the company resides is growing rapidly because it is flexible, simple to run, and does not require all the paperwork of corporations. These are the few types of ownership. Now the second concept is of capital. What is capital? The answer is that capital includes the cash and other financial assets held by an individual or business and is the total of all financial resources used to leverage growth and build financial stability. Capital can include funds held in the deposit accounts, tangible machinery like production equipment, machinery, storage buildings, and so on. Raw materials used in manufacturing are not considered as a capital. There are some examples of capital like company cars, patents, then softwares, brand names, bank accounts, stock. These are the capitals of one of the companies. Capital is not the same as money. Instead of simply spending it like cash, you use it to create wealth through investment. Since you use capital to create wealth, it is considered as asset in your small business. Accounting records Assets are items that add value to your business. Your assets are also items that help you produce the goods and services you sell. For example, equipment. Now we can see about capital gains and losses. When you invest, the capital will generate wealth for your business. And as your investments help grow your business, the capital itself grows in both. These changes are gains and losses of capital. Capital gain example is there. When your worth increases, you see a capital gain. This occurs when your investment is worth more than its purchase price. For example, if you buy a truck for $1,600 to help you move equipment for your lawn care company. The truck needs work, but you fix it without needing any new parts. You then come around and sell it for $2,000 because by fixing it you gave it a higher value. Now to calculate the gain in your small business accounting records, you take the final sale price of the truck $2,000 and subtract your initial purchase price, that is $1,600. So your accounting record should reflect a gain of $400 is the total capital gain of your business. Similarly, like this you can calculate capital loss example. Capital loss. Now the example is that when your worth decreases, you see a capital loss. This happens when your investment worth less than its purchase price. With the lawn care company example, let's say you still buy a truck for $1,600. As you work on it, you realize it will cost more money than you planned. You spend $800 on new parts, but you then sell the truck for $2,000. Between the cost of the truck and parts, there is a $1,600 plus $800. You spend a total of rupees $2,200. To calculate the loss in your small business accounting records, you take the final sale price of the truck $2,000 and subtract your total investment into the truck, that is $2,200. You should have calculated a negative $200 and this should be reflected in your accounting records by loss of $200, that is the calculation of capital loss. Now we will see growing capital. Many small business owners fund their own capital when starting their business. Sources for startup funding include personal savings and zero interest credit. Many small business owners fund their own capital when starting their business. You might also try to get a small business loan from a bank or credit union by presenting a business proposal. Venture capital firms may help you grow your company in return for equity or partial ownership of your business. Once you establish your business, you begin gaining funding from other sources. You should gain capital primarily from your profits. As you gain equipment, property and other assets, your capital grows. When it grows, the worth of your business grows. And last point is that working capital. Working capital is specific kind of capital in your business. You are working capital to pay for the day-to-day operations of your business. Working capital converts into cash more quickly than other investments. For example, a new oven at bakery. This means working capital is moving in and out of your business more quickly, so be sure to keep up with record. This is all about the capital in business. This is all about today's session. In the next session, we will see budgeting, matching entrepreneur with the project and so on. Thank you. Thank you so much.